This is a Professional Edge. My name's Sean Todd, tax attorney, CPA, and certified financial planner. Trying to put things together for you as a listener here on your investment portfolio concerns. We left the last session talking about a buffered ETF, and it basically boils down to an agreement basically for 1 year. That's the time period. And it says, I'm okay with not getting all the upside within an index, but I'm also a little bit leery on the downside, so I want some downside protection as well. So we can buffer this and say, okay, anything up to 15% gain on the S&P 500 index, I get. Anything over that, I don't get. But I also want some downside protection, which says, okay, if the market goes down up to 15%, then I don't participate. I get nothing. So therefore, if the market drops by 12%, I don't participate in that 12%. I am back at zero. That's when zero becomes your hero. So I'd rather have a 0% rate of return than a minus 12% rate of return. So we have that. But if we're at a 15% downside buffer and the market goes down 20%, meaning the S&P 500 index in this example, then we would actually participate 5% down. We wouldn't be fully down a 20% loss. So if this is something for you as a listener here on the Professional Edge, and this is your investment portfolio concern about protecting your principal, because the legendary investment Warren Buffett only has 2 rules for investing. Number 1, don't lose your principal. Rule number 2 is don't forget rule number 1. So you got to ask yourself, you're getting your 1099 statements for taxes in, you've looked at your portfolio, or at least you look at your holdings in your portfolio. Not really. All you do is look at the value of your portfolio. And you got to ask yourself, be honest with yourself, what do I have in place that will protect my investment principal? So if you don't have anything and you have this sundry items of mutual funds, well, there's no real protection for the downside. You just let it roll and let the market take control. Well, that's not a very prudent strategy. So that is one way to protect your downside risk, is a buffered ETF. And again, there's not a full guarantee. They're only guaranteeing this buffer amount on the downside. So it could be a 10% down protection, 15%, 20%. But the downside of this is, well, if the market really takes off and gets a 20% return, you might not be able to participate in all of that upside. Now, that is very different from a fixed index annuity. So what I say is a fixed index annuity is a contract with an insurance company. And basically, yes, it protects your principal based on the claims paying ability of that insurance company. But that fixed index annuity says, okay, your $100,000 goes in. And a lot of times these contracts are for 5 to 7 to 9 years. So we're tying up our principal for that 5, 7, or 9 years. Now, we can always get it back out, but you usually have a very substantial surrender penalty. And it may start on a 9-year annuity at 9 or 11%. So if you go into this contract and you want out at the end of year 1, guess what? You're going to probably pay a 10 or 9% surrender penalty. So just be aware of that. That's the downside. If you want liquidity, these are not your friend. So on that fixed index annuity, it also has moving parts on participation. So it may say you get 80% participation, no cap. Okay, that means if the S&P 500 index goes up 20%, you get 80% of the 20%. That's 16%. You are then credited that 16% to your investment inside that index annuity. And now that gets locked in. It's reset. So then the following year, if the market falls by 20%, well, there's no downside risk. So if the market goes down 20%, you don't participate, and that's when zero becomes your hero. And it says at the end of that year 2, we are still back at our end of year 1 value. So we didn't lose anything. But got to remember, on a fixed index annuity, the only guarantee is the first year of that contract. A lot of them allow the insurance company to mess with the crediting rate within that document or within that contract after year 1. So being an insurance licensed individual, I have reviewed numerous fixed index annuities, and that is sort of my conclusion. Correct me if I'm wrong, but that's not really a full long contract for 7 years, because if the insurance company can change the terms of the crediting, then that's not really a contract. That's not a fixed term contract. So if you're considering buying a fixed index annuity, make sure you understand all that fine print and when that guarantee and the crediting can change, or the insurance company can change that on their election. Because if they change it in year 2, guess what? You cannot just get out of that, because you are still subject to that surrender penalty. So again, these are longer term commitments on that, and the contract terms, you got to make sure. And if it's 100 pages on this contract, then you got to look at the very fine detail to make sure that you are understanding of how the insurance company is going to credit you, and whether they have the ability to change the crediting method during the term of the contract. That's simply stated. So there's that one. So that's another way to protect your principal from downside risk, and it also locks in your gains. Yes, right tool, right place, it's okay. Trying to put the square peg in the round hole, probably not advisable. So again, you have an investment portfolio concern on protecting from the downside. So we've talked about CDs. That obviously protects your principal. It's FDIC insured. Then we talked about fixed annuities, which is basically a contract with an insurance company that says you are going to put on deposit your $100,000. It's going to stay in there for 3 years, and we're going to pay you a fixed rate of return. Are you acceptable to it? Yes. Then sign the document. We have the fixed indexed annuity, which says I put my principal in. There is no guaranteed rate of return, but it's based on the index. And there's multiple indexes. Could be the NASDAQ, could be S&P, could be the Russell 2000. Just depends on the contract on which index is going to be used. And it says, okay, you could have 100% participation with no cap, or it could say you get an 80% participation up to 20%. So that's another way in which they operate to credit your account. So if the S&P 500 goes up 10% and you're an 80% participation, then you would be credited 8% on that deal. That gets locked in. The following year, the S&P falls 10%, has a negative rate of return for that year, then you don't participate in that downside. So you are basically your original principal plus your original 8% locked in. In our example, where we're using 100, so you'd be at 108, not down to 90. So it protects you from the downside. A buffered ETF that we talked about, those basically caps the upside, and then it says, okay, on the downside, you can buffer 10%, 15%, 20%. So if that index falls below that, then you would participate in that loss. So if you had a 20% buffer on the downside, and for some reason the S&P 500 index dropped 30%, well, you would have a 10% loss, but that is far different than a 30% loss, Because remember our example, if you had $100,000 and the market went down by 50%, at the end of year one, your value is $50,000. If the market goes up basically 50% that year two, are you back to level? Are you back to your $100,000? The answer is no, you're only back to $75,000. So in order to make up a 50% loss, the market has to return 100%. So now you sort of see the concept of Warren Buffett saying, number one rule of investing is protect your principal. Don't lose your principal. Rule number two, don't forget rule number one. So that is another investment portfolio concern that we look at. What do you have in place to protect your investment portfolio? Well, the other thing is you might want to limit the volatility within the portfolio for money you are going to spend. So if you're planning to spend $5,000 a month times 12, that's $60,000. And we want to accumulate cash or near cash equivalents that are approaching 3 years of your spend. So we got 60 times 3, so we should have $180,000 near cash equivalents. Could be a short-term bond fund, or it could actually be a CD that you placed in there when it was paying 5.25%. It's okay for that because we know you're going to spend that money over the next 3 years. Therefore, we got to make sure that we're not selling in a down market to fund your monthly spend. So that's part of that portfolio management, that being a tax attorney, a CPA, and a certified financial planner, us at Estate Management Counselors, we put all these puzzle pieces together so that you have that safe and secure retirement. If you want to have that very candid conversation, the first one's on the house, that means it's a complimentary consultation. Do give our office a call at 404-250-9798. That number again, 404-250-9798. The offer I want to also give you as a listener here on the Professional Edge is EMC The Bundle. That is Echo Mary Charlie, thebundle.com. It is a combination to get your estate plan in order. Yeah, you made that New Year's resolution to get your estate plan done. Number two, we look at your income taxes. Yeah, it's tax time, and we go through that. If we need to amend the return and it makes financial sense, let's amend your return. That's there. Or going forward for 2026, what is your tax strategy to not pay the Internal Revenue Service as much money? We all do it legally, obviously. And then on your investment portfolio, have an objective evaluation there. Are you holding the right things in the right accounts? And what have you done to make sure that you have protected your principal to the extent necessary? Again, start that conversation at 404-250-9798. Thanks for listening to The Professional Edge. If you like what you're hearing here, be sure to send this around to your friends, your colleagues via our podcast, which is Professional Edge.
With today's financial markets, are you getting the personal and professional attention you and your money deserve? Clients of estate management counselors benefit from having one set of professionals advise them on their tax, estate planning, and investment advice. We call that the Professional Edge. Sean Todd is a tax attorney, CPA, and certified financial planner. With over 15 years' experience, he welcomes the opportunity to assist you in preparing for retirement, implement effective tax planning strategies, and to help you properly plan your estate. His radio show, The Professional Edge, is aired weekly on Sundays at 9 a.m. If you're interested in meeting with Sean, call his office at 877-654-9798. That's 877-654-9798. Do you want to feel more confident about making the right investment, tax, and estate planning decisions? Today, these decisions are more complex than ever. Have you thought about working with a professional advisor and not sure who to turn to? Not sure what qualifies one to be an advisor? Sean Todd is more than qualified as a tax attorney, CPA, and certified financial planner. Scene is with Estate Management Counselors. Estate Management Counselors operates as an independent fee-only investment advisory firm. They're dedicated to gaining a personal understanding of their clients' objectives and implementing professional counsel and advice to achieve those objectives. So take a second to talk with Scene Todd to learn how you can benefit from their multidisciplinary practice where they coordinate their clients' legal, tax, and investment strategies into one comprehensive and integrated plan to enhance and protect their clients' financial security. You can reach Estate Management Counselors and speak with Scene Todd by calling 1-877-654-9798. That's 1-877-654-9798.